Hi Shani, you wrote a deep dive report on Hong Kong's prospects as a wealth management hub, and you forecast the industry's private wealth management assets to almost double to 2.3 trillion by 2030. What's driving all this growth?
The growth is led by both local wealth in Hong Kong and also cross-border wealth. There's been a flood of new migrants coming to the city recently as they take advantage of the government's new talent visa schemes. This bodes well for household wealth locally. And on the offshore piece, in China, there's a huge population of millionaires as well as ultra-high net worth, ranking second behind the US. The policy is supportive. The Chinese government, they are allowing wealth to flow out via Hong Kong. And also mainland investors, they want to reallocate their assets away from property during the household slump. So this is making high-yielding overseas investments look more attractive.
When do you think Hong Kong will finally overtake Switzerland as the world's largest offshore wealth hub?
Based on our forecasts, Hong Kong could potentially overtake Switzerland by next year, which is 2025, with flows from mainland China as a key driver. When we look at the mainland households' balance sheets, they are substantially underinvested overseas given the capital controls. Its foreign portfolio investment overall is only 6% of GDP, so that's far less than countries like the UK and Japan, which exceed 100%. With Chinese government continuing to nurture the cross-border infrastructure like the Stock Connect and the Greater Bay Area's Wealth Connect, investing overseas should get easier and easier over time. The rich in other parts of the world could also continue to diversify via Hong Kong as well, given the rising geopolitical risk.
Hong Kong authorities have set goals in attracting family offices to the city. How successful has Hong Kong been in attracting these family offices, especially compared to other financial centres?
Hong Kong has about 2,700 single-family offices, which is more than Singapore's 1,650. And in the near term, Hong Kong might extend its lead. There are a few reasons for this. One would be on regulation, where the Singapore government, they are tightening rules after the money laundering scandal last year. Family offices also need approval from the MAS to set up, while there's no such requirement in Hong Kong. Second would be the Hong Kong government's preferential policies as well as tax breaks for family offices, and also the capital investment entrance scheme to attract ultra-high net worth individuals to come to Hong Kong. In particular, for the large-size family offices, there's comparatively less stringent requirements to be eligible for tax concessions. Longer term, both cities should do well. Diversification is a huge trend given the geopolitical risk, and more family offices could set up branches in multiple locations.
And finally, which companies are the most impacted by Hong Kong's burgeoning wealth management industry?
Of the companies that we cover, HSBC, Standard Chartered, the Hong Kong banks like BOC Hong Kong, and Singapore banks like DBS, they have a sizable presence in both Hong Kong and Singapore. They're very well positioned to benefit from net new money from Asia. Some of the global peers like UBS, they actually cut their advisor headcount in the region as they continue to integrate Credit Suisse, although they still remain very committed to the region. Another company to watch would be Hong Kong Exchange, whose earnings benefit directly from cross-border flows.
Shani, thanks for your insights.
Thanks, John.